them. But obviously, when it comes to investors after a challenging first half of the year, they're trying to figure out what the economic road ahead looks like and how that impacts their portfolios. For some more conversation on that, let's bring in Michelle Schneider. She's the managing director at Market Gauge Group. Mich, always nice to have you. We'll be monitoring those central bank comments today, but I think a lot of people are monitoring their portfolio and just trying to figure out where we are in the economic cycle and where we are in the stock market cycle. What stands out to you as we wrap up this first half?
What stands out to me is that, well, first of all, the GDP came out. So it was 1.6 with expected 1.5. And what I thought was most interesting was the consumption numbers, which were 1.8 versus a lot higher. I think 3.1 was the expected, or last month anyway. So what we're seeing now is a lot of debate on, are we heading into a recession? What's going to happen with inflation? Will the Fed be aggressive enough? Obviously, Europe is in its own particular situation with all of these unknowns. This is really, once again, because we've talked about this, John, a real case of stagflation, that this is classic. And in a stagflationary period, as such what we're having, we can see these rallies like we just saw recently, although it was kind of meager at 6% off the lows in the U.S. indices. And then we can see basically either a test of the lows, sometimes a taking out of the lows, but essentially we establish a trading range, and that trading range could last a long time. And clearly that's what's happening right here. And so do it look like we're heading into more of a global recession? Yes. Is there an oversupply of inventory, especially as things are starting to unclog on the supply chain? Yes. But is food and oil under control? Absolutely not. So this is making it very treacherous for long-term investors. And certainly if you are an active trader, you have to be extremely nimble.
No doubt. And, you brought up that recessionary risk. One thing I've been hearing from some of our guests this week is the difference between a bear market and when we're talking about a bear market, I think we have to sort of classify which groups are officially there. Certainly the S&P 500 is in a bear market right now. But the difference between bear market performance when you indeed see an actual recession and when you don't see a recession, and you can ultimately see some differences both in the length, you were alluding to that, of the challenges for the stock market, but also in the overall weakness. And I think that's going to continue to be a challenge for investors who have watched at least pockets of the market that have taken such a crunch that they're having a hard time getting their heads around whether or not this represents a bottom for those groups or if there's going to be more challenges ahead.
Well, absolutely. And in terms of the bottom, I think we have earnings coming up now in the U.S. as well. In fact, I know Micron reports tomorrow, and a lot of people are looking at that as some sort of a lead indicator for the tech space, and we'll see. But it's really going to be, again, a question of what happens. And here's what's so interesting, which is sort of perverse in a sense, is that the more talk we hear of recession, the more people anticipate that Powell will be dovish, in that at least he won't be as aggressive, and this 3% yield that we have will sort of stabilize, and that's it. And certainly we're seeing that in our long bond market this morning as yields are down a little bit and long bonds are actually coming in higher. But the junk bonds, which are really the risk on, have been also really getting hammered. So it's going to be hard to determine what the bottom is at this point. Now, what's interesting is July is a great month because it resets the calendar range. It's halfway through the year. So by mid-July, I think we'll have a better idea on whether we're going to either break to new lows and then find a new level of support, hold where we are and just sort of go sideways with these days where people start buying and then they have to liquidate, or whether or not we actually have truly seen a bottom, which at this point I'm suspicious about, because I still think that oil and food, I think people have discounted. They were like, oh, we've come off 20%. It's over. No more inflation. And that's just, it's insane. It's insane. So I think that really we have to really keep an eye on three things. Number one is what the Fed does. Number two is what oil does. And number three would be what food does. And that's going to really help determine whether or not the overall equities can sustain any kind of footing here.